Did you know that insurance in Kenya is changing and is quietly being transformed, but not in the way you think? Most people won't realize it until it affects their policy. If you work in the insurance sector, whether as an agent, broker, underwriter, student, regulator, or investor, or if you're just curious about where the Kenyan insurance industry is heading, then this video is for you. Hello, and welcome to Insurance World TV, the channel where we break down insurance, money, and risk simply, clearly, and honestly. Today, we are looking ahead to the year 2026 and asking one very important question. What does the outlook of insurance in Kenya really look like in 2026? We will talk about market growth, regulation, technology, investment trends, and most importantly, how Kenyan consumers are changing. Let's begin. Part 1. State of the Kenyan insurance market. Kenya remains the largest and most developed insurance market in East Africa. In fact, Kenya accounts for over 60% of all insurance premiums in the region. The industry currently writes over 300 billion shillings in gross written premiums every year, and it continues to grow at an average rate of between 7 to 10% annually. However, despite this growth, insurance penetration in Kenya remains low, at between 2.3 to 2.5% of GDP, given the current numbers. To put that into perspective, the global average insurance penetration is about 7%. This translates to more than 75% of insurable risks in Kenya still uninsured. When we look at the structure of the market, general insurance accounts for roughly 73% of total premiums, while life and long-term insurance contributes about 27%. Medical insurance is now the fastest-growing line of business, followed by motor insurance, which remains the largest by volume, and then group life and pensions, which form the backbone of the life insurance segment. But here is an uncomfortable truth that many people in the industry already know. Most insurers in Kenya are not making money from underwriting. Combined loss ratios in general insurance remain above 100%, meaning claims paid and expenses incurred exceed collected premiums. What keeps insurers profitable is investment income, mainly from government securities, treasury bills, and bonds. So yes, the industry is growing, but it is also under pressure, highly competitive, and structurally fragile. Part 2. Regulatory landscape. What are the changes expected in 2026? Now, let's talk about regulation, because regulation will shape the winners and losers in 2026. IFRS 17, risk-based capital and consumer protection are some of the regulations that may impact the insurance market in 2026. We expand on them one by one. The first regulation we are delving into is IFRS 17. IFRS 17, which stands for International Financial Reporting Standard 17, is the global accounting standard for insurance contracts. This reporting standard is no longer a future concept. It is already here and fully active. Under IFRS 17, insurers must now recognize profits as insurance services are delivered, clearly separate profitable products from loss-making ones, and disclose insurance liabilities more transparently. The immediate impact has been higher compliance costs. Insurers now need stronger actuarial capacity, better data systems, and more sophisticated finance and reporting teams. In 2026, the long-term impact will be very clear. Insurers who cannot price risks accurately may face challenges which may either force them to seek additional capital injection, merge, exit certain product lines, or leave the market entirely in extreme cases. Closely linked to this is the move toward risk-based capital and supervision. What is risk-based capital? Risk-based capital, often shortened to RBC, is a regulatory framework that determines how much capital an insurance company must hold, based on the level of risk it is exposed to. Capital will increasingly be tied to the level of risk an insurer takes on, not just the volume of premiums written. Poorly managed insurers will struggle to meet capital requirements, and this may naturally drive consolidation. Kenya's market cannot sustainably support the current number of insurers, and we should expect stronger players. Regulators are also placing greater emphasis on market conduct and consumer protection. Claims turnaround times, policy wording clarity, and the professionalism of intermediaries are now under closer scrutiny. The era of selling first and figuring out claims later is coming to an end. Part 3. Technology and digital transformation. Now, let's turn to technology, because technology will be the single biggest differentiator in Kenya's insurance industry in 2026. Kenya has one major advantage. Mobile penetration is above 95%, and we have one of the most advanced mobile money ecosystems in the world. This has enabled mobile-first insurance models. Daily, weekly, and flexible premium payments are becoming more common, especially in health and microinsurance products. Insurance is increasingly being embedded into mobile loans, e-commerce platforms, and digital wallets. Artificial intelligence is also no longer just a buzzword. In 2026, more Kenyan insurers will be using AI for claims fraud detection, automated underwriting, customer service chatbots, and risk scoring in medical and motor insurance. The benefits are clear. They include faster claims processing, which builds trust, lower fraud aimed at improving pricing sustainability, and better data, which leads to better decision-making. As insurers digitize, cyber risk is also rising. Data breaches, system downtime, and ransomware attacks are now real threats. Cyber insurance is emerging as a niche but necessary product, especially for SMEs, corporates, and digital businesses. Still under technology, let's talk about partnerships. In Kenya today, technology is not replacing insurers. Instead, we are seeing partnerships and collaboration. Rather than disruption, insurance companies are working together with technology companies, also known as Insurtechs. Insurers are partnering with Insurtechs to make insurance faster, simpler, and more affordable. Brokers are also working with digital platforms to reach more clients and serve them better. What does this mean for you as a customer? It means you may buy insurance through digital comparison platforms, where you can see different options in one place instead of visiting many offices. It means policies can now be issued instantly through secure digital connections between systems, without paperwork or long waiting times. It also means insurance companies are moving their systems to modern cloud-based platforms, which are more reliable and easier to access. All of this is designed to reduce delays, cut costs, and improve your experience as a client. In 2026, these partnerships will be more common, and insurance will feel less complicated, more transparent, and easier to use. Part 5. Kenyan consumer behavior. What's changing? Now, let's talk about the most important stakeholder in insurance: the customer. Kenyan insurance consumers are changing. Here are some of the things they value. 1. Convenience. Today, convenience matters more than brand loyalty. 2. Easy access. Customers want to buy insurance on their phones, get clear information, and have claims paid quickly. 3. Good claims experience. A poor claims experience often leads to non-renewal of expiring policies and even cancellation in extreme cases, as well as long-term mistrust of insurance altogether. Consumers are still price-sensitive, but they also expect value. Affordable premiums, clear benefits, and fast claims are no longer negotiable. The growing health and life awareness. Health and life insurance awareness has grown significantly since the pandemic. Health insurance is now seen as essential, and life insurance is increasingly viewed as a tool for family security, education, and income replacement. Group schemes continue to drive most of this growth. However, insurance literacy remains low. Most Kenyans still buy insurance because it is mandatory or because it is provided through their employer. Voluntary uptake is still limited, which means education-led selling is no longer optional. So, what will success look like in Kenya's insurance industry in 2026? The winners will be insurers who price risks correctly, pay claims fast and fairly, invest in technology, educate the market, and focus on trust, not just premium volumes. Kenya's insurance future is not about explosive growth. It is about discipline, innovation, relevance, and above all, trust. That brings us to the end of our feature on the outlook of Kenya's insurance sector in 2026. As we look ahead, 2026 is a mixed bag. On the one hand, we know what is expected from a regulatory perspective. The rules are clearer, the standards are higher, and the direction is well defined. But on the other hand, how the market responds remains uncertain. Pricing, consumer behavior, innovation, and competition will ultimately determine who adapts, who struggles, and who leads. What is clear is this: the insurance sector is entering a period of adjustment, not comfort. For insurers, intermediaries, and policyholders alike, the year 2026 will reward preparedness, transparency, and long-term thinking. And as always, we will continue to track these changes, break them down, and keep you informed. Thank you for watching Insurance World TV. If you found this video useful, please like it, share it, and subscribe to our YouTube channel at Insurance World TV. And let me know in the comments, what do you think will shape Kenya's insurance industry the most in 2026? Until next time, stay insured and stay informed.